Turn to the markets this morning. Bob Biachino of LotusBrokerage.com is standing by at the CME. Bob, good morning to you.
Good morning.
Wondering, what's the bigger topic of discussion, Europe and Ireland, or this idea that the president today is expected to say he's not going to maintain those tax cuts for the wealthy in this country?
Well, to be honest, I think they mean the same thing in terms of how they're going to affect the market. You know, the market was up near 7% last month, and I think the new normal that PIMCO talks about, the new reality that a lot of us believe is here for the next 2 to 3 years at least, is that you can't expect 7%, then 5%, then 6%, then 2%. And that's why this little bit of a rest, say, from the rally doesn't bother me as much as it probably would, where we are seeing larger volumes and larger fears come through the market. I don't particularly think that talking negatively about the tax cuts at all is the right thing to do. I'm not here to talk about the politics of it. I don't really care because you're talking to me about where the market's going to go. I just wish there would be a comment of we're going to leave everything the same and just focus on jobs, because that jobs number was slightly positive, in my opinion, with the private payrolls, but just not positive enough. We're focused on Thursday again and the jobless claims number.
Right. Does today's announcement, even with the tax credits and the infrastructure talk of earlier in the week, does it threaten whatever kind of rally we managed to cobble together last week?
I just think it doesn't help it. It's just not the right thing to be saying. It's that continued sort of stubbornness we're seeing from the White House, where the public, the equity markets, the tech sector, everyone with all this cash is just waiting for all the right things to be said. President Obama right now is not in a place, in my opinion, it's my opinion only, to go out and say that this is the right thing to do, even though the markets are not reacting that way. This is not a political statement by me at all.
Right.
You would just like to see the administration say that we're going to leave everything in place and continue to try and create jobs. We're perhaps going to take a little bit different path than public spending, which a lot of that public spending still hasn't come into play and isn't creating the kind of long-term job growth in the short term that we need right now to push this past.
Yeah,
it's 50% retracement,
but you put it together,
which is where we're stopping.
I understand. You put it together, though, with the concerns about Europe and Ireland today, this morning, and people look back at last week and say, that really wasn't much of anything when you think about it. It was a rollover to a new month. It was on low volume. It was about beating an economic consensus number with data that really wasn't that good to begin with. Was last week a mirage or not?
You know, I think it could have been a foundation, really, if it would have gotten a better jobs number. You saw the VIX coming off dramatically with the rally, which told a lot of people that the fear was coming out of the market with the rally. There won't be tremendous volume. There just won't until we get tremendous job growth. You're going to have to see 3 to 4 months of job growth before you see volume come back in. So I'm looking at a new normal in volume, to be honest. The new normal in volume is that we won't have the equity market rallies on high volume that we've had in the past 5 to 10 years. It just won't be there.
Yeah.
You're seeing it in gold, but you're not really seeing it anywhere else.
Right. Speaking of which, what do you make of gold? We're not far away. Did we match the record high yesterday or not?
I think we got close.
Right?
You know, gold is funny to me. I like gold, but the talk of gold is really, in my opinion, a little bit overblown. The move from gold from 2001 to now is very similar to the move in equities from 1990 to 2000, when they went from about 2,700 to about 11,000 in the Dow. It's a very similar type of move, same type of drastic volume to it, and everybody needs to get involved that we saw in the 90s in equities. The thing about gold, though, that I find funny is that it's a physical commodity. It can be held. Nobody really trades it that way. They go into ETFs. They go into the equity markets. But if gold starts to come off, it's a good thing for equities. So you're only talking about, nobody really recommends any more. I think the max I've seen is 20% of someone's portfolio in gold. Most recommend 5 to 10. So even if gold comes off and goes back from 1,300, where I think it's going in the very short term, all the way back down to 250, 300, it shouldn't affect people's portfolio by that much.
Yeah, you hear some of the bulls talk about if the ECB has to get back in the money printing game, it has some room to run, but we won't know.
Even the gold bugs, Carl, aren't going to tell you, well, we need to be 60% invested in gold,
right,
like some of the equity market bulls would be.
Yeah. No,
oh, yeah, they do.
60%, Joe. Come on.
That's
the real gold.
Does anyone take?
Response.
Let me rephrase. Does anyone take them seriously? Does anyone take them seriously?
No, but they'll tell you 100%. Are you kidding me? Gold and canned goods.
Well, they would say silver, too.
Gold, canned goods, Sturm Ruger, and bottled water. They're everywhere.
Guns and ammo.
You know what? I don't snicker anymore. 2012 is coming, my friend.
Mayan calendar.
That's all I'm telling you. It could
Were
be
the Mayans invested in gold? Was there a lot of Mayan gold?
No,
You
I
mean end of
mean
days.
sunspot, some type of huge solar surge. It's going to knock out the power grid. It'll take 10 years to rebuild society. I mean, who knows? But
I'll tell you what, whoever's president at the time will be blamed for the end of the world. That's for sure.
No, they won't. It'll still be Bush's fault.
Yeah, we'll blame Bush.
Yeah, there'll be a president blame, but it's going to be. That'll still be.
You know, I really think
You're going to give him back the keys after
Joe.
driving it into the ditch? No.
I really think one last thing. If they weren't named the Bush tax cuts, there might be a little less reluctance to sort of just let them extend temporarily. You don't have to believe in the philosophy of tax cuts for the wealthy. They're called tax cuts for the wealthy.
I like the
$250,000 in New York is not wealthy. I'd argue in Chicago.
We were just saying that. That trip pays for the trip to Spain. I'm saying that suddenly the Clinton level of taxation is the end-all, absolute, be-all. Anything above or below that is either a cut or an increase. Why is that suddenly the standard? Why isn't the standard back to where it was?
Because these tax cuts were put in as temporary. Because they weren't put in as
permanent. But instead of saying they got to be paid for, take away the spending. Instead of saying they have to be paid for, take away the spending in the future.
But the reason is because they
we should just call them. We should just call them the temporary tax cuts.
They couldn't though, because
we call them the temporary tax cuts. There might be a little less vigor in terms of letting them expire.
You might be right about that, Bob. Thanks. Good to talk to you.